Well, FCC, we need a new crew. Come on in, y'all. The water is fine. Come on in. Come on in, y'all. The water is fine. Okay. That mic works. Mic works well. Hello, everybody. Sir Walter Jones Show. I am he. It is Thursday. No, Wednesday. Wednesday. Let's see. Today's date is the 7th of June, and we are in another wonderful evening edition. Baby, I'm on the whiteboard today. Hadn't been here for a little while. I'm so sorry, y'all. I've been derelict to duty. Today, I'm going to start my series on building your credit up. Credit worthiness. We're going to do a series. I might do this every Wednesday, to kind of get myself in the groove here. I don't know. Yeah, I'll try to do this every Wednesday because there are so many people out there who are struggling in your finances. You're trying to buy this car, you're trying to buy this house, you're trying to buy this big item, you're trying to get credit cards and what have you, and your credit score is low and you're trying to figure out why. Number two, you're trying to figure out how can I build it up. Well, all right. So today what we're going to do is talk about the FICO score, what it is, possibly what it is not, and then take you through some of the different types of scores, how it affects your credit, and then next week we'll bring up some other stuff, okay? Because there are different types of credit reporting agencies. We'll talk about that next week. Then we'll talk about how to handle your collectors, okay? We're going to talk about hard inquiries. We're going to talk about bankruptcies. We're going to talk about student loans. All these things. Just keep tuning into the Sir Walter Jones Show, and we'll kind of help you out there, all right? All right. Now, a lot of stuff here you guys know, so we'll just talk. If you know about this stuff, it's okay. Still, you can hit the share button and share it with somebody who probably do not know. Join me on Generational Wealth for African Americans. That is a Facebook group that I have created, GWAA. You can just type that in, Generational Wealth for African Americans. And you'll see all of the wonderful posts from people who are trying to get you to come out of your do nothing and get off of your tush and get out there and do something to make some money, all right, and to build generational wealth for your family. So that's the importance of me doing this today, okay? So we're going to start from the very beginning, elementary, my dear Watson, elementary, and then as we go further, we'll go into more advanced stuff. And after a while, after a few months of this, you're going to see that your FICO score is going to start rising, and some of you who are looking to get that big box or that big item, or possibly just want to have good credit without buying anything, you just want to have it just in case of an emergency or something does happen where you need to get something on credit, or what we used to call on time, then hopefully these things will work here. FICO, Fair Isaac Corporation, that is the name, that's what it stands for. Many people didn't know that, but that's what it is. Oh, Mr. Isaac, okay? It is the largest and best known of several companies that provide the software that calculates your credit standing. You get that? FICO. I would even go as far as to say that 90% of all creditors use Mr. FICO. That's a lot, 90%, okay? And that's been going on for umpteen years forever. Well, in walked another score in, I think that was 2006, okay? This guy here, it's called the Vantage score, popped up, all right? Now, these three reporting agencies, TransUnion, Equifax, and Experian, did the same thing that in the music industry, many of the top 4, 5, 6, gosh, there were so many of the record labels out there. They were large, they were big conglomerates, and they were doing great all through the 1900s until we started getting to the digital age where people started ripping them off by pirating the music and the sharing and what have you, and copying and what have you. So the labels couldn't survive, all right? So they had to come together and join forces, and some began to inquire each other, buy each other, okay, or take over, and all these things or they just came together and said, you know, we can survive better if we come together. And that's what's happening here. TransUnion, Equifax, Experian came together and formed what's called a Vantage Score. All right, about 10, 11 years ago. All of them have been sued recently for misleading reporting procedures. Yep, Shantae, you are absolutely correct. Okay, everybody getting sued. This is America. All right, so that's what's going on. Now, you're going to find out when you pull your credit report, you're going to see all kind of weird things, all kind of inconsistencies, all kind of stuff that don't belong there. Your name is there, but that's not your middle name. That you do have an account with them, but that's not the account number. Anything you see, whether it's a dot out of the way or a comma or an explanation point or anything that might be incorrect, you can challenge that thing and possibly get stuff deleted off of your credit report that could have a big impact on your FICO score. You'd be surprised the things that I got taken off of it because I questioned something that was incorrect. And in many cases, you will find something it's like taking your utility bill, your cable bill. You know, some of us are very lazy and we don't do it. So when I get my bills, whether it's, ComEd or whether it's People's Gas or Nightcore or whatever city who provides your utilities, I open it up and I go line item by line item by line item. And I come to find out that in many cases there is a lot of incorrect information. That may not be a whole lot, but it might be one or two items that's not correct. I'm being overcharged. My cable company was charging me for an extra DVR box for months, and I didn't know it. I just kept paying the bill for months. And I looked at the bill one time just because I was having just a boring day, and I said, why are there two DVRs on this bill? And I only have one. And I called them back and got my refund. So you can do that here. You're going to there'll be some times where you may find some inconsistencies, okay? If that makes any sense, all right? So here's the Vantage Score. I itemized it here for you so you can see the difference between the two, okay? And how it affects you. In the Vantage Score, you notice that it starts off at 300. Just like the FICO score starts at 300, but they categorize it. The Vantage Score categorizes it differently than the FICO score. You'll see Vantage Score numbers on Credit Karma and a lot of these free creditreport.com and all these other free services. You will see a lot of the Vantage scores. Okay, if you're going to these free services, you're going to see the Vantage Score more so than you will FICO. If you're going to get a good FICO score, more than likely it's going to be a paid service or it's going to be on a trial basis, okay? So the score is different. It goes from very poor to fair to good to excellent. Well, the FICO score goes from very poor to fair to good to very good to exceptional. Two different things. You're going to notice that as you continue to search out your own personal scores here. 17% of the people, okay, in America have very poor credit. 300 to 549. If that's your score, you're among 17% of the people. Very poor. Then it goes up to 550 to 649. Okay, that's a poor score. 34%. Now, for instance, if you go to maybe, actually what Credit Karma would do is once you get to like 650, then they will say that's fair, okay? 18% of you are in this fair bracket right here, just 18%. So I know there are people who they'll say, it seems like, and I thought this too, that the average American fall into here, but it's really only 18%. If you notice, the high scores, those who have excellent credit, their Vantage Score, that's 30% of Americans. 30%. That's a lot of people who actually have excellent credit. All right. So don't settle for fairness thinking, well, most people have that. Well, no, not really. Most people have this poor. But as far as excellent, 30, just 4 points less. Okay, it's almost as equal as people that are poor. are the same as those who are excellent as far as the Vantage score is concerned. But the FICO score, you see these numbers are different as well. Good credit, 22% of the Americans have good credit, 22%. Okay, as far as exceptional credit, 20% for your FICO score. So they tend to change, all right? Some of you are getting your scores from your bank. For instance, I get my score from my bank. Bank of America will give me a score. So if my score is 650, for instance, I can go to Credit Karma, and if my score is, let's say it's 650, I can go to Bank of America, sign up for their free credit reporting, okay, to get my FICO score, and it may say 590. You're like, okay, possibly they're different, they're coming from different agencies. Nope, because this score is TransUnion, and this score is TransUnion as well. You're like, how is that possible if they're coming from the same agency, but I'm getting two scores from two agencies, from Bank of America and from Credit Karma? You see how it's all over the place. And to be honest with you, you don't know what your score is. You just don't know. The only ones who really can give you a fair analysis of what your score is when you go down there and try to get a loan, either a personal loan or a house, or maybe a car. Now the car industry, they will pull from your Vantage score. But if you're trying to get something bigger than that, more likely it's a FICO score and other little things that we'll talk about as far as mortgages is concerned. Okay, so it's a really tricky thing. It's all worked by algorithms. It could be crazy. It can drive you crazy. But if you continue to follow our classes here, you'll see that these scores will climb by just the little things that you do, and you need to be patient. Be patient, because when we talk about the getting credit cards, getting signature loans, things like that, and how just over time you'll see your stuff rise. I remember when I was trying to get my first real apartment, I was living in South Dakota, and I moved down there, and of course, you know, you couldn't get an apartment unless you at least had a job and you had a decent credit, at least good credit, okay, at least fair credit, all right. But more than likely they wanted good credit. So between these two here, and I remember having them run my account, my credit, and it was so low till I was so embarrassed. The woman said to me, we had never seen a report that low. Well, I had been using cash only. I operated by cash only. I was a young entrepreneur, and I didn't care about credit. Everything that I wanted and got, I pulled out my wallet and paid cash for it, or I pulled out my debit card where the cash pulled from my bank. That's the way it was. I didn't care about credit. So because I didn't care about credit for so long, when it was time for me to get an apartment, my score was so low. I mean, it was in between very poor and poor. They was like, we have never seen. And I was so embarrassed that I had to go and get a co-signer to sign, put their name on the lease so that I can lease rent. I mean, that's how embarrassing. And I said, never, ever again will I go through that. And so from that moment on, I began to try to build my credit by at least getting, either getting credit or cleaning up the mess that I made. All right. And so what I decided to do was launch out there in the deep to kind of even go even deeper into this so that I can be bona fide to teach this class, by the way. So what I did was December, just a few months ago in December, I looked at my score. It wasn't the way I wanted it to be. So I says, Walter, here's what you're going to do. You are going to go and see if you could, let me make sure that this thing is not ringing. Okay, y'all hold on, because I know this phone don't ring. Let me see. Okay, y'all still there. All right. I have to remember that I got an old iPhone here and a new iPhone here and another thing here. And when the phone rings, it just interrupts everything. Okay. So what I did in December, I decided to launch out there and see if I could raise my credit score over a short period of time. Okay. And so I did. So what I did was, of course, I went on these sites. I went to my FICO Score. Let's see. And I'll tell you about the best credit reporting sites out there, okay? But I went to all of them, all right? And I even signed up with LifeLock, okay? Y'all know what LifeLock is, right? LifeLock. I think that's right. LifeLock.com might be, I don't know, okay? Where if anybody inquire of my credit, whether I gave them the permission to do it or not, I get a text, I get an email, I even get a phone call from LifeLock and saying that someone just pulled your credit report. All right, someone is using your social security number. And that right there was worth the little fee that I paid. I think I was paying like $9 a month for me to have that. And they were finding things for me, and so that I can go and they'll tell you who was it that pulled it, and then you can go and find out what that's all about. Okay, so that's worth it, the LifeLock. So I went there and I signed up for LifeLock to stop identity theft. Okay, very important. Good insurance, by the way. And then I went to the VantageScore sites to pull my report because it was free, and I began to see the accounts that I had on there, and I said, okay, Walter, you about to clean this stuff up because in another couple months, you're going to see your score go up. And that's what I did. And I started going in there and trying little things, okay, and things that we're going to be talking about over the next few weeks. I tried them, and my score went from in the 550s, went all the way up. Okay, over a couple months, I raised my score 100 points by doing just simple things that you could do. Okay, and you can use, and it really doesn't matter if your score is low, and you're trying to get a car. Or they're gonna give you a car, right? Oh, trust me, they're gonna give you a car. But what you also gonna be hit with is a high interest rate. Be anywhere between 20%. Sometimes I've seen 25% interest rate on the car. Okay, and we call that thing what they call that? They call that subprime. Anybody know what that is? Yeah, man. They see you coming. Okay, because they see that your score is low up in here somewhere, and they says that okay, we're gonna make our money right here. How much you got down? You got $500 down? Okay, well, we'll take it. Okay, give us the $500 down. We're going to get you in the car of our choice, not yours, because you can't afford the car that you want. And we're going to hit you with this APR right here. And bam, it's going to be something that's really not worth the time of day. Okay, so these are some of the things that you need to pay close attention to. And you got to work on patience. All right, the purpose of me doing this is to tell you how you need to operate in patience to get your score to climbing up to 700. Some people are going to take them a while because some of you have bankruptcies, some of you have student loans, some of you have tax liens and things like that. We're going to talk about that. Judgments, a lot of that stuff can be erased. They got these things, these tax liens and judgments, public records. I can't wait to get into that subject there. Public records. Okay, these, of course, are the tax liens, the judgments, the child supports. Gosh, it could be anything that's dealing with something that you deal with the government or public. Okay, and those records have to be implemented. See, the government or the city or where you live, they don't really necessarily report this to the agencies. The agencies get a third party, and the third party implement the public record into your reports manually many times. And because it's done manually, errors also happen. And you want those errors to happen because if there's one number off on your account, guess what you can do? You could call, or through some of these Credit Karma or what have you, you can actually do all that stuff online and debate that public record. Something is off. Maybe they misspelled your middle name. Okay, you want to find those errors because that stuff, that public record, that tax lien, that judgment, that IRS it can be wiped out. I've seen it with my own eyes, okay? We're saying, uh-oh, I done dropped my thingy. I go boom. Theo says, teach brother, send me a message on how you set up this broadcast for FB Live. I want to do some. Okay. Yes, sir. Yes, sir. I got you. All right. Let's talk. Disputed and it will be deleted. That's what Demetri Brand Triplet said, y'all. Disputed and it will go away because they have. See, the reason why you want to dispute it is because, see, the public records, they really ain't got time. Especially if you're going to the courts, going to a judge or some court dealing with the creditor things, okay? And there's not enough manpower. They really don't really care about your credit report, in a sense, okay? So they're not going to show up to the court, all right? And more likely they're not going to respond to the letter that goes out. They're not going to respond. And after a certain amount of days, when they don't respond, it's got to be removed by one of these things. And once it's removed, that 650, boop, climbs, okay? And you keep doing that. Keep searching it. And if you don't see anything wrong, keep looking at your report every month. Don't just sit there and say, okay, well, I'm good. No, keep looking at it every single month and check it out. You're going to find some things. Again, I found stuff. I can't go there. Okay. All right, so that's what that's all about, the public record, okay? So that's what the FICO score is all about. Again, 90% of the creditors use this, all right? If you're trying to buy something, they don't really use this, they use this. You're going to see this is just a soft idea of what your credit is. So don't get excited if you look on Credit Karma or some of these other places, Credit Sesame, freecreditreport.com and what have you, and you see something like 700, do not get excited. Okay, because it may not be 700. It may be 650. Okay, it may be 650 over here on the FICO. And guess who the creditor or the institute who wants to lend you the money or give you the house or the car? Guess which report they're going to look at? Not this one. They're looking at this one, and they're looking at some other things that I'm going to share with you because there are various credit reporting agencies that deal with different things that you want, okay? The banks have their own credit reporting thing, like check system. That's another reporting agency in itself, okay? Some of you have wrote some bad checks. All right. I don't remember last time I've ever done that. Okay. So let me give you some ideas here on some of my notes here. Where did we go? Where did we go? Okay, I want to talk about, here are some of the things. It says the FICO versus the Vantage score. There's 5 differences that you need to understand about these two scores, okay? Once you find out what those differences are, it'll make sense on why you need to pay closer attention to these, even if it costs you money. It's only a couple dollars, okay? You spend that money, on breakfast or lunch or dinner or something. Go here and do it the right way, okay? If you don't have the money right now, just go here and get an idea of the breakdown of the people you owe, but don't pay attention too much to the FICO score. Number one, the scoring models are different between the two. FICO basis, its credit scoring models on credit reports belonging to millions of anonymous consumers obtained separately from each of the CRAs, okay, these guys. They then build a separate model for each based on that agency's data. FICO score ranges, of course, from 300 to 850. We said that, okay? But Vantage score, on the other hand, develops its credit scoring models using a combined set of consumer credit files from the 3. So these 3 got together to create this. All right, so that's the difference between these two. Number 2, credit scoring requirements, they differ. The requirements for these differ. Not everyone has a credit score, since any scoring formula requires at least some amount of credit experience upon which to base its predictions. And for those of us who do have credit scores, whether FICO or Vantage, there are many different ways to obtain a copy of them. All right. And we'll go over this stuff next week and the following weeks. All right. So let me real quick give you the difference between these two. Number one, the scoring models are different. Number two, credit scoring requires the requirements to the scores is different. Number three, late payments are not created equal. Yeah, that's next week. Number four, how inquiries are counted can differ. The inquiries, meaning you're trying to get a credit card, that's a hard hit on your credit report. Okay, or if you're standing in Sears or Target and they're trying to offer you a credit card at the register, fill out this application, that's a hard hit on you. Okay, it differs. All right. And number five, low balance collections may affect one and not the other. The low balance collections. Okay, we're going to talk about collections and why you need to, in some cases, walk away from those collection agencies. Don't even pick up the phone. It's going to affect your credit report. Don't pick up your phone. Don't do it. We'll talk about that later on. Okay. All right. I want to talk about how it's all calculated, though. All information has to be accurate. That's right. Demetrius says that here. It's calculated. Your payment history makes up 35% of your score. 35%, y'all. Your payment history. What does that mean? Pay your bills on time. If it's done, if your bills are due on, for instance, your credit card bill, if it's due on the 20th of the month, I suggest you pay that sucker a couple of days ahead of time. One of the nice tricks of the trade is to pay it twice a month. Okay, because as you tend to, I think Demetria mentioned that yesterday. You kind of tricking the system a little bit, as if you paying a lot on it. Okay, or new payments. What you do is, if it's due on the 20th, well, you pay on the 2nd and you pay on the 15th if you can. Okay, you just pay. If the bill is $50, you pay 25 up here and pay 25 down there. All right. I'm telling you, I did this stuff and I started noticing my credit score going up. And I didn't know it was doing that. I was trying to figure out why my scores going up like this. And I went back and thought about it. What are the things that I do every month? I double up on my bills. Okay. Sometimes when I get a new bill from my cell phone or maybe the light bill, something like that, if I see a bill, the due date is way down there, but I pay that thing just right away. Or I'll pay a little here, and then close to the due date, I pay the balance, okay? And you just have to find your rhythm, okay? Hey, late, but I'm here. Yes. All right, we just started, Evelyn. We ain't that long into here. Yeah. Okay. So that's 35% of your score. 35, that's a lot. Don't miss a payment. Please, people. Never, ever miss a payment. And what I suggest you do is do an auto pay. That means, tell the bank to pull that credit card payment out of there. And if you don't think you're going to have the money in there, get you an overdraft protection. Many of you have that. Get an overdraft protection and have it pulled from that. Okay. Some of you don't qualify for overdraft protection because that's all about credit too. See, it's all about a credit world. So what you do is get you a checking account and get you a savings account in the same bank. Link those accounts together so that way when the credit card pulls from your checking account, if it's not enough in there, always keep money in the savings account. Always keep putting money in there so that you'll always have enough on reserve just in case you get low. All right. Don't use your savings not as a place to, use it for an insurance policy. I guess you can say that. Okay. How about that? All right. That's 35%. The next one is the accounts owed. How many accounts you got that you owe? That's 30%. All right. It says here, accounts owed refers to the amount of money an individual owes. Having a lot of debt does not necessarily equate to a low credit score. Rather, FICO considers the ratio of money owed to the amount of credit available. All right. And they give a wonderful illustration here that says an individual who owes $10,000 but has all of his lines of credit fully extended, okay, and all of his credit cards maxed out may have a lower credit score than an individual who owes $100,000 but is not close to that limit on his accounts. All right, and we will talk about the utilization. Okay, how much of your credit card are you utilizing? So payment history, 35%. That's huge. Pay it on time. Okay. I'm still here. I hope y'all still here. I had to go to the camera and see what's going on. All right. We got this internet thing going on here in the office. Okay. All right. Y'all back? Okay, good. Length of credit. We were talking about the length of credit as a rule of thumb. The longer an individual has had credit, the better its score is. Okay. However, with a favorable score in other categories, even someone with a short credit history can have a good score. FICO scores take into account how long the oldest account has been opened. Okay, if that makes any sense. All right. So I opened up a credit card. I went to my bank. Okay, and I needed to boost my credit somehow. So I told them that I got money in the account already. I want a secured credit card. I said, so let me get the secured credit card, the money that's already in my account, just pull it from there, put it in a bond, a savings bond. They usually do that. They'll either put it in a savings bond or they'll keep it in your account or whatever. They use it as collateral, and they gave me the card, and I used it and paid it off every month. Used it and paid it off, and I tried to make sure that I didn't use 30% of the utilization of that card, because going above 30% hits your credit score. Okay, that was 3 years ago. All right, so because that card is my oldest account, right, it fared favorably on my score, caused my score to climb, because it's 15% of your scoring. All right, new credit is 10%. So if you're applying for a new credit card today, it's new now, but 6 to 12 months from now, it ain't going to meet new. It's going to be placed over there in the length of credit, like the card I got 3 years ago. You see what I'm saying? So if you're trying to build your credit, go ahead and apply for a card. I think one of the good things you can do is go to Credit Karma or these other sites. And what happens is, if you go to that site and you see that your score is anywhere here, here, or here, what's going to happen is they're going to put a credit card next to that to tell you which credit cards would favor you well. Meaning they'll say, very good, you have a very good chance to get Capital One. Okay? Or it'll say, you have a good chance of getting the American Express. It'll say, you have a fair chance of getting Bank One card. Okay? You have no chance of getting this. Okay? So you go to the ones that says very good. All right? Again, this is what I did. And I saw the one that says, I think it was a Capital One, and it says very good. I says, I'm going to apply for it, even though it's going to be a hard inquiry on my credit report. That's fine. I'm not planning on buying any big items right now. It might be another year from now before I go and build that house from the ground. So I got some time to play with my credit by building it. It's called pay to play. Okay? And so what I did was I went and applied for that card, and bam, they approved me, and right away my score, I don't remember what it was, so I've been messing with 650. What happened was, when I applied for that card, right away, immediately, it said 650, then there was a number that did this. It said 7 with an arrow going down. Okay? You know what that meant? That meant that your score went down 7 points. Okay, why? Because of that hard inquiry from Capital One. Okay, that affected my score because it was an inquiry, brought it down 7, and that pulled from my TransUnion, but it didn't show up on the Equifax end. Okay, so which worried me. Why? Because if I'm going to apply for a credit card, I want that credit card to report to all 3 agencies. It doesn't make any sense to try to build credit and that card that you get only report to 1 agency. Because when I go and buy that house or car, they're going to pull from all 3. So if that credit card that's building my points up is only pulling from TransUnion and not from these 2 guys, it's not benefiting me as a whole. Okay? So if you're going to apply for a card, make sure you do your homework and find out if Capital One, if Bank One, if Chase report to all 3 agencies, and then go ahead and apply for it if you have a good chance of getting it. Okay? Your score going to go down a few points. One of the cards that I applied for went down 18 points. That thing said 18. I said, ouch. But it doesn't matter. You know why? Because even though it went down 18 points, when I get that card and then they give me, let's say, $300 credit on this card, when I get it, turn the card on, go out there and shop. Okay? Buy something that's less than 30% utilization on that card. And then what I did, I went and put that money back on there. Did that a couple times, did that for a couple months. That 18 points down there, first of all, when I got the card, that $300 was on the card. Once the first bill come to my house or online, what have you is, I paid it. Capital One reported that I paid it to the credit agencies. And that 18 points low went up. Because now the credit agencies are showing that I have now $300 that's readily available to me. You see? And that's how you build new credit, and that's how you build up your score, is that my score was 650, but and I had to wait, be patient until this first bill came in, Capital One reported to the agencies, and that 650 went up to 660, 665, because now I got $300 readily available to me. You understand? Even though that initial application knocked my points down 18, just a few weeks later when the bill comes, it went shoot. So you got to pay to play, if any of this makes sense. All right? So if you want a credit card, don't stand in the line at Walmart and Wall Drugs or wherever you are, and they trying to offer you these cards. Don't do it, because it's going to be a hard inquiry on your account, on your credit report. You don't want to do it because you probably don't need it. All right? Now, if you know your score is kind of good, you could get that card because depending on what your score is, you'll get it. You'll see it going down, but that's fine if you think you need it to build your credit. But pay that sucker on time, please, because I told you 35% of your scoring is on payment history. All right? The last one, but not least, the credit mix is 10%. Credit mix. All right? Credit mix is a variety of accounts. To obtain high credit scores, individuals need a strong mix of retail accounts. So that's Walgreens. I don't know Walgreens give a Walmart, Target, Sears. Okay, Macy's. Okay, so that's retail accounts, credit cards like Capital One, Bank of America, Chase. Installment loans such as signature loans. Okay, so walk into your bank. You got $500 in your bank and tell them you want a signature loan, and the money is already there. What's going to happen is your bank is going to write you a check for the $500. You endorse it and give it right back to them. Don't touch it. Put it back into your account Okay, and then you tell them to automatically pull from that $500 every month. The fee might be 30, 40 bucks every month. Okay, tell them to pull from that. You got $500 in that account, but you're going to have to put $550, $575, or $500 or $600 because they're going to charge you interest on this loan. It's a signature loan. They got to make their money. So you got $500 in that account. When you're ready to get that loan, you put another $75 in there or $100 and leave it alone. And over 6 months' time, they're pulling that money back out. It's still your money. You're just borrowing it. Okay, you're borrowing your own money. What's happening with your credit report? It's climbing because your bank is going to report to these agencies, and you make sure your bank do that because depending on what your institution is and who they report to, make sure you ask them before you get that signature loan, do you report to all agencies? If they say yes, get that personal loan. Okay? All right, is that helping you, Jackie Hines? Okay, so get a mixture of credit. Don't just get credit cards and say, okay, I'm going to build my credit up to 800. No, get a mixture because that's 10% of your credit. So that's credit cards, installment loans, vehicle loans, okay, and mortgages. All right? I hope that helped you all out there. Okay? Let's see. I think the last thing that I want to talk about is the best credit reporting, maybe websites that you can go to kind of give you an idea of what you need to do. Let me see if I forgot anything. Checking my notes here to make sure I didn't forget anything because I don't want you guys leaving here wondering. Okay, I think I got everything there. Here's one, freecreditreport.com. Now that's Experian. Know that when I mention Credit Karma pulls from TransUnion and Equifax. Credit Karma do not pull from Experian. All right? So if you're only using Credit Karma, you got to go to Experian.com and get a free report from them. Credit Karma will give you TransUnion and Equifax report. Okay? And there you have it. All three of your agencies free of charge. But they're going to be Vantage scores. Just know that. Okay? So go to freecreditreport.com. Free Credit Report is actually Experian. I think they started that. Number 2 is TransUnion. Go to transunion.com. Get a report. You can go to Lexington Law. Lexington Law on Track. That's a great place to go. People swear by it. All right, they're the top 5 credit reporting agencies, and they will actually help you clean up your credit with a nominal fee. It's going to be about $25, okay? But it's well worth it for some of you out there who's trying to do some cleaning, okay? And I know some of y'all, that's y'all's competitor. I think it might be Demetrius' competitor, all right? And some people have had some bad experiences with Lexington Law, and the equal amount of people had good experiences. So what I usually do before I purchase anything, I look at the consumer reviews. I don't purchase not a stick of gum until I can find out, does this gum cause cancer? Let me go to Yelp and type in Wrigley Spearmint Gum. Okay, what are you saying about this? Because I don't want to buy something and it wind up being a horrible product, all right? So before I did my research on any of this, I go to the consumer and try to figure out, okay, how did this affect you? Before I got my Capital One credit card, before I got my Bank of America credit card, I went to the sites to see what the consumers were saying about the card. What is the customer service like? If it's horrible customer service, I don't want that card. Okay? What are my chances of getting that card if I've got a 550 credit score? So I went to find the people who had 550, and they said, okay, you can get the card, but they're only going to give you 300. They're only going to give you 100. But if you got this score, they'll give you $1,000 credit. Okay? But if they give you $300, you keep paying the bill off. After 5 months, the $300, they're going to give you $1,000 on that. They're going to up it $1,000. So when I started reading all that, that made me determine which card did I want to get. All right? So Lexington Law on Track, $25, and many people have sworn by it, and others have been bit. Okay? All right. Evelyn, all you got to do is rewind this tape. I'm not going to do a review. Just rewind this when we're done. Because people have already heard the beginning, and I don't want to do that. Number 5, Credit Sesame. Credit Sesame. They also offer insurance, okay? Of course, there's an upgrade, a paid upgrade, but Credit Sesame is another good one. IdentityForce.com is another one, and they give you all 3 bureaus. MyFICO, very popular. MyFICO.com gives you 3 bureaus, and they give you a lot of great information on there. GoFreeCredit.com. They have a 7-day free trial. GoFreeCredit.com. Number 9, FreeScoresAndMore.com. Okay, they have a 14-day trial. I've looked at all of these, and I come to the conclusion that these are possibly the better ones. Of course, Equifax is one. Equifax.com. They have an ID protection, just like my LifeLock. Okay, and Equifax, you could actually. Do you not know that you can lock your credit report? Did y'all not know that? You can actually tell Equifax to lock your credit report and unlock it at your will, so that nobody can go and check your report and do a hard hit and hard inquiry. They can't do it because it's locked. Yes, Equifax, do that. Credit Karma, we talked about that, and that's these 2 guys right here. Okay, all right. So I hope that helped you out. All right. So this is the general. This is just a general introduction to what your FICO score do for you, what the Vantage score really is. Okay, it's just these 3 guys coming together to create this score. Don't get caught up in these numbers, because they're soft numbers. Don't say you see $700. $700 on your score and think you have arrived. You have not arrived, because that's just your Vantage score. Your Vantage score. I say Advantage, but it's Vantage. Okay. Pay more attention to the FICO score. They're more realistic, but yet the institution that's trying to that you're may want a loan from, they're going to pull from all 3 of these guys, and they may go a little deeper in it. How long you been on your job? Okay, they'll look at other factors. Okay, yes, learned that recently. Yep, that's right. They can lock you. You can lock your stuff. Now get LifeLock. Everybody and their mama is stealing y'all's identity, because some of y'all are careless online. You're careless. Your email accounts are being hit. Okay, they're being hit hard because you guys are opening up stuff. I'm seeing horror stories with mortgages where people have spent, they put away $200,000, and when they got to closing, when it was time for them to pay this money, somehow these hackers hacked the mortgage companies, the closing companies, okay, and sent these bogus emails to people who were getting ready to close, and told these people to write them the check or wire the money to the company, but it wasn't the company they were working with. It was a bogus company from Egypt or somewhere, and folk lost thousands and thousands of dollars, okay? All right? So really, it was worth me spending $9 a month to LifeLock to protect me from intruders, because every time somebody tried to pull my credit, I got an email, I got a text, and I got a phone call, okay? And I went right away to search, seeing who this is. And sometimes I was doing it and forgot I had LifeLock, okay? When I went to get this Capital One card, I applied for it. Bing, got a text right away. I mean, seconds. I'm like, who's looking into my credit? What's going on? And I'm like, fool, you just applied for a Capital One. Okay? So please, people, protect yourself. How do you tell them to lock? You meant to say lock. Okay, go to Equifax. Evelyn, go to Equifax.com, and of course you got to pay for some of these services. And you go there, and you can actually there's an app And on the app, just like your security system at home, I have a security system here. While I was in Brooklyn, okay? While I'm in Brooklyn, I look on my app here, and if I forgot to lock the window or set the alarm or what have you, I just right there, click, I set the alarm from Brooklyn, New York, all the way to Chicago, okay? We got the technology is wonderful today. If I need to let the electrician in, let the mailman do something, I don't know, I can unlock the door and what have you. So Equifax is the same way. You go to the app, boom, lock your account. Remember that it's locked, okay? And then go by your business. That's another way of protecting you, okay? Because if you don't remember that it's locked, you'll go and try to apply for credit, and it's like, okay, it's hitting the wall, okay, hitting the wall. Now, if you looking into your own credit report, that's not a hard inquiry at all right? It's a soft inquiry. When you look, it doesn't affect your credit report whatsoever. And pre-qualifications do not affect your credit score. So if you're trying to get a loan, a personal loan or what have you, and you get these things in the mail that says you've been pre-qualified for this loan, no, it's not a hard inquiry on your report. Your numbers will not change. Those pre-qualifications are very soft, okay? If any of this makes any sense, all right? So please, people, be patient. This may take some of you 6 months to a year or more, depending on how much you got on your report. Again, some of you got bankruptcies. It's Chapter 7, Chapter 13. You got student loans. You got tax liens and judgments and all that stuff. And all that stuff can be wiped off your credit when you be patient. It's going to take you month to month to month because it takes a while for it to be reported. So you can't do all that within a week and think, okay, I'm going to clean this up in a week. No, it takes time for all these things because it's all about algorithms and it's all about how the credit card companies, when they're going to report it, all right? And when you trying to negotiate with your debtors, when that's going to happen, okay? That could take months, but you're gonna thank yourself, all right? And if you absolutely have no time to do this, you absolutely have no time, you at your job, 9 to 5, 12 hours, maybe what have you, and you just don't have the time, then find a reputable credit repair place, okay, that can help you out. There's a couple here, all right? Demetria Triplet is one of them, okay? There was another one that I think signed on, okay? They can help you at these minimal costs. I mean, we've seen some stuff that was, thousands and thousands of dollars just wiped off these credit reports, okay? And it just costs you a minimum cost for a credit agency to kind of help you out. Now, there's a lot of bogus folks out there that are trying to rip you off because they're doing the same thing that you can do for free, all right? So they're banking that you don't know nothing about this. So they can charge you these erroneous fees, and a lot of times sometimes they mess your credit up because they got so many clientele, they ain't got time to really spend time with you, okay? There's a whole bunch of them out there. Another remnant of those out there who can really help you clean your stuff up because they do it every day, all right? I'm new to the game, but there's some cats out there who do it absolutely every day, and they are on it, all right? Okay, I hope that helped you. Need your contact information, Robert. Okay, well, hit me in the inbox, Robert. Just hit me in the inbox. Thank you, Shante. I'm trying to say reputable. When you've been talking as long as I have been today, you don't know what you're saying. Okay. So next week we could talk about. There's a whole lot of stuff we want to talk about, but I'm going to in depth on some things that you can clean up. All right. I don't know which one I'm gonna tackle first, whether it's bankruptcy or tax liens or judgments. I don't know, or inquiries or collections. I'm on tax something, okay? But as far as your credit card is concerned, some of you who have good credit, okay? Let me silence this because this thing is going off. All right. What are you saying here? Let's see. Your credit, for instance, if your credit is up here, 740, 799, very good or exceptional, and you have children, okay, and you're trying to help them build their credit up, quickly, put your child on that credit card. Don't give them the card. You're not putting them on the card so that they can go spinning. No, they don't need a physical card. That's what I did. When I opened up my account, I put my child on there, all right? But I don't give her the card. Now, I can if I want to, okay? But I may be with her because, these millennials, boy, they'll rob you, okay? Put that kid on that card and help them build that credit up, okay? And as they build, what's happening is that the people who they go, let's say they want to buy a car or they want to get an apartment or what have you, the report will show that their score is up, but the institution won't know it's pulling from you. You see what I'm saying? They just see that this person got good credit. Okay, so you want to do that to help your child out. Okay, and it's almost like a co-sign type thing, and I'm not really into co-signing. But if this is your child, then I suggest you do this if you're trying to help the child build up his or her credit. They're in college, or they're on their way out of college. They're getting ready to start a new life. Help them out. All right, because my white brothers and sisters do it, and we're trying to build generational wealth. Okay, so give them a kick. Okay, but also teach them this. Don't just give them that stuff. It's like what they say about feeding a person for a day. What say? Give them fish. You feed them for a day. Yeah, you still have to teach them this. Okay, because once they build it up, then they'll be able to apply for their own card. They could apply for American Express and get it. Okay, now they have their American Express card, and then they are paying on time. Okay, then you can remove them from yours if you like to. They got the card that they need. Okay, so go ahead and do that. All right, I think that's all for today's lesson. If you got any questions on this right here, go ahead and hit me up, and I can give you some more things. All right, that you may need. Some of you may or may not know that the reporting agencies are now wiping out your tax liens automatically anyway. So if you have tax liens right now that's on your report, they may not have rolled it all out to you just yet. But many of you, I can't remember the percentage of you, many of you will start seeing your tax liens without you negotiating anything being taken off your credit report. And you're going to see your scores rise, okay? So I know mine did. I had a tax lien, a few $1,000s. And then I looked on that report and it was gone. Poof! They were supposed to do it in July, but they did it early. Okay, I was excited about that. Now, you still owe the tax. I still owe the tax. You see what I'm saying? Don't be derelict to duty. You still need to pay. The Bible says, owe no man, all right? So still pay your taxes, okay? Render to Caesar's what Caesar's. But as far as my credit report is concerned, thank you, Jesus. Now, I will say this, though. The older, this might be important to you, all right? Let me say this. The older, let's say if you had an account, let's say you had a tax lien that might have been on there since, I'd say, 2006, okay? Well, what happened was it had already affected your FICO score in 2006. Your FICO score went down then, okay? All right? Fast forward 10, 11 years from now, your FICO score went up. Because this tax right here don't have the weight that it used to have on your FICO score. Because if it's showing over a few years that you have been paying your bills on time, getting new credit, and the new credit turning into old credit and things like that, well, it's taking the weight off of this tax, this judgment, even this bankruptcy, okay? Even these student loans, it's taking the weight off of your score. And every few months to a year, it goes higher and higher and higher and higher, All right. So if you notice that you may have $10,000 worth that's owed to the IRS, and it's a lien on your credit report from 2006, and then your score is, let's say, 550. Once this is removed off of your account, whenever it happens, when it rolled out on your end, your 550, let's say, may go up to maybe just 600. You says, I'm only getting 50 points for $10,000. You know why? Because this didn't have much of a weight on your score anymore because years done went by. You see? So if y'all seeing stuff on there from years down the road, but it's still on your report, don't get too worried because it's not really affecting your FICO score as heavier as it did in 2006, maybe 2007. All right? If that makes any sense to any of you. Now, if you're trying to buy a car, it doesn't matter. If your score done went up here somewhere and you're trying to buy a car, then, it doesn't really matter that much. They just want to make sure that you got a job and you got at least decent credit. But if you're trying to try to get a mortgage or something like that, then yeah, you may want to try to get that off. All right? Because it's a little more serious. You're getting ready to have a relationship with a bank for 30 years, possibly, if you don't double up on the payments and pay it off for 15 years. You're getting ready to have a relationship, all right? And they want to make sure that you just don't get into a situation, all right? We're going to talk about critical care, because, I am in insurance, all right? And for those of us who, y'all go out there and get your mortgages or getting a car, okay? People buy cars and they don't know that the car company offer what's called gap insurance. And gap insurance have saved a lot of folks financial stress, okay? That gap insurance is going to bless you. Insurance in itself is good to have, the gap insurance. So there are the mortgage companies also, some of the banks offer critical care. All right, so if you buy a mortgage for $150,000 that the house is owed, okay, is worth. You've got a house that's worth $150,000. Your mortgage payments is $1,000. What happens if you get sick? You can't work anymore. You still owe. All right, that $1,000 a month. Whether you're sick or not, the bank don't care. They want their money. All right, but with critical care insurance, you put that into the mortgage now, so your bill might be $1,000 and let's say $1,050, $1,500. I'm sorry. Let's say it's $1,100 a month now because you're paying $100 every month for critical care. That might bless you because if you get sick and you can't work and you're gonna be down for a few months, then that insurance kicks in and pays your mortgage for an extended amount of time. Okay, so it's good to have this stuff, and that's why I said gap insurance is good to have, because if your car, let's say the car was $10,000, okay, that's what the sticker price was. But once you went through all of these, the APR, because you had horrible credit, okay, and they charge you an APR of 20 or something percent. All right, that $10,000 car is going to run you, let's say, $17,000 now. Okay, $17,000. So it's worth $10,000. You're going to be paying $17,000 by the end of that 5 years. All right. If you don't have any gap insurance and you have a car accident, depending on how bad the accident is, the car company, the insurance company is going to want to settle or total the car. All right. Well, what they're going to do, they're going to open up what's called the blue book, and they're going to see that this car ain't worth $10,000. It's worth $4,000. Okay. All right. It's worth $4,000. What they're going to do? They're going to write a check $4,000 to who? The car company. Right? Guess what? that 17,000 minus the 4,000 is what you gonna owe the car company, whether you got a car or not. You ain't got a car now, but you still got to pay that note. And the reason why you still paying it because you didn't get the gap insurance, and that's what gap is. It fills in the gap. So if you had the insurance will pay the difference. Okay, your insurance is going to pay the 4,000. Gap will pay the difference, and you're good to go. You walk away clean and go down and get you another car. Okay, so it works the same way with the mortgage company. All right, you owe $150,000 on a house. You get sick and you can't work. That critical care kicks in and pay your mortgages every month. All right. Anybody learn anything here? Okay. So we want to talk about this every Wednesday if we can. If y'all just hang around 9:30 every Wednesday, let's talk about this. I might even feel a need to double it up. I don't know. I just feel like teaching. I haven't opened up the whiteboard in a long time. Okay. But we want to talk about how to build financial wealth, generational wealth. Teach this to your children and then teach it to your children's children. Why? Because my generation wasn't taught this. My white friends, they were taught this, but my generation was not, because there was a gap. Y'all got all this, right? Okay, you got all this, all right. My generation, okay, y'all forgive me for doing all this extra teaching, but I just have to go here, okay? You got the WW2 generation. They call that the greatest generation, okay? And then you had the baby boomers, okay? And then you had Generation X, and then you got the millennials, okay? Let's call it that. Let's call it that, okay? Robert said he's signing up. Okay, all right. Now I'm not offering anything, Robert. I'm just offering free stuff right now, but I'm packaging this stuff. So get ready. All right. So WW2, that's the greatest. They call it the great generation. That's great grandpa to some of y'all. They dying off 1,000. I think they said 1,000 a day is dying every day. 1,000 of these are dying. Before you know it, they're going to be gone. But they came back from the war in 48? I can't remember. Victory over Europe, I don't know. I think it was VE Day, and then VJ, okay, victory over Japan. And what happened is when they came home, they started having babies. That's what these baby boomers are. That's your mother and your father, depending on how old you are. I'm in my 50s, so the baby boomers are my parents, all right? And they began to buy homes, okay? They were born in the 1940s, and through the 1950s and the 1960s, what happened was the greatest generation bought homes, had babies, and they either gave the homes to the baby boomers, they willed it to the baby boomers, taught them how to work hard. The baby boomers bought their own homes, okay? And they made African Americans became wealthy through real estate. Right? I'll give y'all a quick class there. Real estate from the South all the way to the North and to the Midwest. That's how they became wealthy. So you see those people marching in the 1960s, the civil rights, okay? These were not a whole lot of poor people. I went down into Atlanta, Georgia, okay, on Auburn Avenue where Martin Luther King's house is, and these were wealthy people that was upscale, middle class to upper class. These people were wealthy because they were homeowners, and that's how African Americans built their wealth. All right. Then there was a gap between the baby boomers and the Generation X. That's my generation. The Generation X, they're like 50 right now. All right. They're in the mid 40s to 50s. Okay. Generation X. What happened was they are the Pepsi generation. Okay. We got caught up in the 1970s and the 1980s, and the baby boomers began to relax a bit. They began to have a whole bunch of babies, but what they did not do, though, was pass down much of the knowledge, see? Because there was this flight, there was this great migration from the southern cities, okay, to the north, all right? So down here in the southern belt, the Bible belt, that's what happened. They was coming up here to find a better life for themselves. That's what the baby boomers did, okay? So they went up into Detroit, up in Chicago, up in Milwaukee and Midwest, and they began to live in slums, some of them. They went into the project areas, okay? Cabrini Green here, Stateway Apartments, Henry Horner, all these high rises here. So they began to live in apartment dwellings. But many of them were able to buy homes, okay? They bought these bungalow homes, especially in Chicago, okay? All right? And then, but what happened was they worked hard, worked on their jobs for about 30 years, and they retired, all right? They were trying to put us, Generation Xers, into college, and they spent that time working hard to keep us in college. But what they did not do, again, was passed down. How did they do this? One of their mistakes was they just willed it to us, right? So they began to get sick or die off. We began to take care of the baby boomers, okay? And we didn't understand the value of taking care of the very same thing that made them rich. We didn't know how to take care of that stuff, and the house and the property began to fall upon us. And then the white flight, that's the ones who flew to the suburbs because they saw black folks moving in there. They flew to the suburbs in the 1950s, 60s, most of the 60s and 70s, okay? Because when my family moved to our neighborhood, they were still white folks there. They moved out, moved down there, or they moved up north, okay? Found a better life, okay? And then what happened was they began to make a return back to those same neighborhoods where we are now, and now they broke down and tore down. They're not worth the money they should be worth, and these white folk went back up in those neighborhoods and began to buy up the taxes, the delinquent taxes, okay, the foreclosures. They went in there and started building up abandoned buildings, okay. They began building up, and then they began to rent it to who? Us. Absolutely. And some of them, they just built it up and began to move their families back in there. Okay, so we have what's called this regentrification. Gentrification, that's the word, okay? All right, and this stuff started happening, all right? So I just want to take you through that real quick. So everything I just taught you for the past hour, much of this stuff was not taught to the Generation X, okay? We were too busy in college trying to make a name for ourselves and bragging about how many degrees we got, okay? And wasn't teaching this to our children. And I said I was going to break that. So my children know this stuff that when I call my children up, I ask them, what's your FICO score today? Daddy, let me check. Well, you better check, okay? That's the conversation I have with my children now. We don't talk about what Beyonce say and what's the newest dance and what's the newest craze. No, we talk about wealth. That's, as for me and my house, we talk about wealth, all right? So that's what happened to us, Generation X. So now the millennials, well, what's going on with them? Well, whatever you're teaching them was what's going on with them. Okay, you're right. My generation wasn't taught this. I learned the hard way. Oh, I know. So I hope this helps some of you. Go ahead and hit the share button and let folks know that we're doing this every Wednesday, and hopefully it will help some of you renegotiate your brain and think differently. Stop thinking about making more money. Illinois just passed a law that says McDonald's and Burger King and then the minimum wage. Okay, they raised it to $15, and everybody's celebrating and marching in the streets and saying, "Thank you, we won." But here's the problem with raising it to $15: is this: that generation don't know about any of this. You see, so he went from making $10 or less, okay, to now he's making $15. Guess what's going on in his mind? I'm making more money now, and he's thinking about buying this, consuming that, okay? So really what they should have put in the bill is the same thing that they put in the conceal and carry. You can't do a conceal and carry unless you go down there and get certified to shoot a gun. You got to go to the range. You got to practice or what have you. So they should have done that before they raised it up to 15. They should force these folks to get into credit counseling. because they're getting ready to go deeper in debt because the more money you make, the more you're going to spend. So I'm not against the raising it, but two things are going to happen. Number one, they're going to spend more money and go deeper in debt. And number two, McDonald's and Burger King and all these other fast food restaurants are going to start cutting. They're going to start cutting folk because they're going to feel like they can't afford to pay more money now. And so there's a catch-22 here. It's just the way it is, all right? I'm in economics. So, trust me, I've been studying this thing for a long time. I went to school, got my little degree in accounting, and I worked for a CPA firm, and some of the things I saw in these books just made my teeth fall out. I saw some of the most wealthiest people's books into the most poorest folks' books, okay? I worked for a CPA, African-American firm. Dorothy Brown gave me this, got me hired to this job, and I saw some stuff in the books. I said, man, I didn't think I would ever see the stuff that I see here. And I said, I'm not going to make these mistakes. And some of the stuff I saw, so yeah, I'm going to do this right here, all right? So here's my opportunity to go ahead. We got social media that can help you out. All right. Thank you. Sorry for the interruption here. I guess when I put this on YouTube, maybe I can edit it. I don't know. If I do, I want to take that time? Maybe not. All right. Hit the share button. If you're on YouTube, go ahead and hit the subscribe button. And let's do this again on Wednesday. Tomorrow, well, y'all know how it goes. Those of you watching this live. Bible study. That's for my Christian family. The rest of y'all can just go somewhere else unless you want to hear some good Bible study. That's tomorrow at 5 p.m. Blessings to you. See you.